So hi everyone, I'm here with Nevan McBride, who's the Risk Practice Director at JayWing today. Welcome, Nevan. Nice to see you. So
you too, Chris.
Today we're going to chat a little bit about, I suppose, what you've seen from a data point of view and from a modelling point of view, which obviously you're very closely involved in. But I mean, first off, I was kind of interested in what's been your experience over the last 6-9 months with the lockdown. I mean, has that been how have you seen the impact from an industry point of view on your clients and their end customers?
Yes, absolutely. Yeah. So we've been helping our clients, I think, initially to understand what the impact would be. So when the pandemic first hit back in March, April time, I think lenders are really keen to try and understand, okay, how is this going to impact our losses, provisions, capital? And so a lot of our help was dedicated to looking at different scenarios, albeit the knowledge around what was going to happen at that point was sparse, of course, with the unprecedented nature of the pandemic. So it was really about trying to look at different scenarios and understand, what the implications would be with regards to losses. So it's understanding what the losses were going to be, and then perhaps utilizing that to formulate post-model adjustments for provisions, because of course models in this climate, and we'll go on to speak about this later, are proven to not work as effectively.
And what was the view? I mean, initially, everyone went into lockdown, and it felt like and we had the payment holidays that came through as well. So that sort of like changed the dynamics of the way the reporting would work. And I suppose that probably impacted through to, the various like IFRS 9 models, etc. at the back end. I mean, what was the net impact of that?
Yeah, I mean, I guess if you put that data through models, then in effect, customers were looking better, because we had, perhaps people that were maybe due to go into arrears through events outside of COVID or prior to COVID, they were in fact looking fine. And added to that, you had different spending behaviours as well. So people spending less money on credit cards and things. The initial period of lockdown. And so, of course, the models then aren't working as well. We've got data going in that's not reflecting the situation because, of course, government measures are stemming the flow of default, and we've got people furloughing, supporting individuals who may have been made redundant. So, yes, I think lenders were very quickly conscious of this risk and had to put measures in place to try and combat. So there's essentially less faith in the models and the output, but with perhaps more measures looking at sort of policy rules and things, and trying to understand sectorial impacts and using other data that doesn't traditionally go into a model to understand what risks may lie ahead.
So the workaround, I suppose, is it's like an overlay, right? So you put an overlay in based on like an assumptions around like economic indicators and sort of like things you're seeing in the wider economy. Is that kind of the approach that's typically been taken, I suppose?
Yes, from a provision. Yes, because IFRS 9, for instance, IFRS 9 models, they have economic models within them that is incorporating and trying to model the impact of the economy. But those models were built on past data that's past downturn periods that doesn't look like this. Downturn is completely different. I mean, every downturn is different, but this one's vastly different from previous ones. So generally economic models can't handle the reductions in GDP that were forecast. I think it's a 30% reduction at one point, and unemployment rates soaring to the levels that they were forecast to. So the models were essentially in a lot of cases broken, and so yes, overlays had to come in to play to mitigate against that the model risk essentially. And
imagine, so this also applies to like credit bureau data as well. I mean, so a lot of I'm thinking about collections segmentation models as an example, right? Or even acquisition models. A lot of that's links to credit bureau data, but even the historical credit bureau data is going to change as well. Credit bureau reporting was stopped. I think if you're on a payment deferral or payment holiday, it was you weren't impacted. How's that going to ripple through? Maybe these are questions we can't answer yet, but how do you think that's going to ripple through?
Yeah, well, essentially, yeah, you're right. That data is looking cleaner than it should, and so that's coming into the models, and yeah, affecting the models. But now that the payment deferral periods are over, I think then the reporting, if there's obviously some firms that are still applying forbearance measures to people that are still impacted, particularly mortgage portfolios. So I guess that data will start to reflect the forbearance measures that are applied now.
And maybe to turn into greater weighting. So if you're now re-aging through after being on a payment holiday, then that might be greater weighting in terms of potential for loss or potential for default as a result. So sort of like it changes and even changes the dynamics going forward as well.
Absolutely. So yeah, I think what firms, a lot of our clients found that there was a high take up of the payment deferrals, but actually the first wave there was quite a large proportion of people came off those payment deferrals, and the theory was that a lot of people took up these the opportunity to have a payment holiday. They perhaps didn't need that payment holiday, and these were probably the more savvy sort of individuals, and so a large proportion came off after the first wave, and then the second wave, and there's quite a small proportion that are remaining. Generally, I think that's across the board. I've heard clients talk about 20-30% of the people that initially took up the initial payment holiday, and so yes, there's a real focus on that remaining 20-30%, and what the firms are doing is looking at particularly the sectorial sectors, the industry sectors, the employment sectors that these individuals or companies are in, and trying to use information and project forward the chances of default based on those sectors.
And it really feels like the portfolios have to get cut a different way. So you just mentioned around employment type, and it's like, so things that, it's industries where people might have had really super stable employment and really quite well paid jobs have now been, some of them have been decimated as a result of this. So hospitality is an example, but even like the airline industry as well, where capacity has been massively reduced, and it's almost like, even though it might be a great job, the likelihood of returning back to work, there's just less demand for those roles, and yet sectorally, or even from a historically point of view, it would have been in a pretty good spot. And then you've got other areas, I suppose, where people actually save money in some ways. So, for example, public sector, as an example, seem to have been fairly stable through this, because the government's sort of, making sure it has to work through a lot of these schemes, and they've actually probably, if anything, been better off because they're not been commuting to work and spending in the same ways. The shops are shut. How do you see that kind of working? Do we have to rethink how we sort of segment our books?
Yeah, well, I think that perhaps historically firms weren't necessarily interested in collecting this kind of information, particularly employment sectors that their customers were in. So yeah, I think there has to be, I think there's been tactical measures to collect that data when providing payment holidays. I think that will happen going forward. It's always about, enriching your data, isn't it? And understanding what data is useful to help predict in these circumstances.
And are you seeing customers or your clients starting to think about doing that and sort of building that in a systematic way? Because yes, we've had a pandemic, and we need to do it now to do these models going forward. But is it actually going to ever change? Do we just need to be doing this anyway, just gathering the extra data and using the extra data to make better decisions?
Yeah, I think so. I think a lot of firms will be taking measures to move from this whatever tactical approach they're using to collect this data to something more strategic. Yeah, I think obviously it's always the more data, the better. And if this data is particularly, I think that it's well known that this sector data is going to be very invaluable, really, in understanding the losses in your book. Then yeah, measures will be taken.
I ask about more data in full knowledge. I'm asking someone who looks after modelling. So I think I'd be surprised if you didn't say that we needed more data. But it seems like a good kind of way for us to go. If I asked you just a bit about like different modelling techniques, I think that if that's okay. So around sort of like, there's been a lot of discussion around machine learning, different types of mathematical algorithms that can be used within that, and certainly from a lot of modelling is still done using sort of various types of regression kind of methods. How do you sort of, and there's been concern, I suppose, around explainability, but I mean, what's your kind of view on that in terms of how that's going to evolve, in terms of like what we've seen today, and then how you think that's going to go going forward?
Yeah, sure. So I think so we've been working on machine learning for quite a few years now, and we understood straight away the importance of explainability in those models. Because machine learning models, by their nature, go off and do weird and wonderful things, and you have to be able to control and explain what's going on in your model, particularly if you're making application decisions, and those need to be obviously fair and they need to be robust. So yeah, I think there's that explainability and the ability to solve that, and have an explanation behind every credit decision you're making has been a bit of a blocker really for the banks, sort of adopting this. So they've spent a lot of time probably in sort of innovation data science teams trying to understand this and trying to find areas where they can actually deploy these models, because they understand the power that they bring by the very nature of the mathematics that underpins them. They will exploit interactions between variables, and you can bring in and utilize more variables, and you will get uplifts in predictive power. We've seen sort of 5 to 20% typically. Yeah. In Gini and predictive power of the models. But there's been obviously the explainability is one aspect. There's also been that lack of knowledge and comfort from the regulators. So typically application models, behavioral models are utilized within regulatory model frameworks such as IRB and IFRS 9. And so there's been this reluctance really to just sort of replace the standard linear models with non-linear models, given the sort of the lack of, I guess, widespread use and familiarity from the regulators. So it has been that I think that the larger banks have been looking at ways in which they can use these models, and that's been probably in pre-screening eligibility type models, fraud, for instance, where explainability isn't an issue, and that's been giving them that, I guess, the understanding of the models and familiarization with them. Before COVID, so the year leading up to COVID, so throughout 2019, the regulator, it's clear that the regulator, so the ICO, the PRA, and the FCA have been actually doing their homework on machine learning, because it's clear that they understand that the industry is moving in that direction. So there's a lot of insight, a lot of comment, white papers, thought pieces from the various regulators, and they all seem to be it's clear that they've got people working on trying to understand the models and the implications of these models. And so there's been a lot of talk around things like interpretability by design. And so designing your AI model, your machine learning model with explainability built into it, essentially. And so now that the regulators are commenting and clearly getting up to speed on these models, I think banks are starting to realize that perhaps there is going to be that opportunity in the near future to start to utilize them more. And that's the larger banks, but certainly what we're seeing with the smaller organizations who perhaps aren't as heavily regulated because they're not banks and maybe not taking deposits. They are starting to roll out these models and utilize them to make credit decisions as we speak, because the benefits are just clearly there.
Yeah, so it sort of seems like, you know, in this sort of tiptoe in some areas where it's not necessarily critical, then there's definitely more of an acceptance, and that's where sort of like you cut your teeth on that, but then you're starting to see them the ML type models, non-linear models, then going to more sort of like harder decisioning type areas, like I suppose like acquisition or credit decisioning, those kind of things, versus communication or versus marketing pre-screening, those kind of things. Is that kind of what you're seeing?
Absolutely, yeah. I think it's starting with the newer fintech style lenders who are perhaps being I guess the investors of these organizations like to hear the word AI, so they're perhaps more of an incentive for them to look at AI and roll it out to make decisions. But certainly, we've spoken to a few of these lenders, and we're trying to push the importance of explainability, and that isn't always understood because perhaps these guys perhaps aren't from that background.
And going into the almost like the maths in a bit more detail, which is, I mean, there's obviously different mathematical techniques you can use, you know, which you got neural networks is one, and there's other types of that, some of which are more explainable versus others. Do you think it's going to bias one type of algorithm versus another, so you can be more comfortable? For example, I think it was like random forest as an example was one of the ones that I'd heard, versus say neural networks, which just seems very sort of like black box in terms of understanding the way it kind of works. Do you think we're going to see biases in terms of this one's allowed, this one's not allowed, or do you think it's going to is it going to skew that way as well as just machine learning, or even AI is even bigger term that sort of like is a blanket for a lot of stuff? Do you think there's nuance in the detail?
Well, I think they're all essentially black box in nature, because they tend to leverage a number of different variables, and then of course there's multiple interactions going on between those variables. So it's very difficult to understand exactly what's going on under the bonnet of those models. So whether it be GBM, neural nets, random forests, we've done quite a lot of studies looking at applying different approaches and understanding the benefits, and the benefits tend to be very similar in terms of predictive power. But the important part really is, the important aspect to all of this, irrespective of what machine learning approach you adopt, is having that explainability built in, or some means to explain the model. I think that is going to be key. If you're using a machine learning model, and in the whole it should make sensible decisions, but there will be that odd decision that could perhaps come out into the press and
from a modeling point of view, we spoke a bit about modeling and the impacts that have been on site, some of the attributes and the data that's come through as a result of the pandemic. I mean, presumably that can still affect your acquisition models as well. So in terms of like looking at cutoff scores and how that be going forward, if you just still use the same models for the old data, then they might not be predictive. What's your sense around how that's going to look at going forward? Do you think there's work that needs to be done to change them, and are they going to underpredict or overpredict, or what's your kind of view on that?
Yeah, so I think what lenders have had the realization that the models weren't going to work as well, and of course there's the risks downstreams from when you enter into a downturn. So the measures that were taken were to raise cutoffs, or perhaps introduce policy rules that looked at different aspects of data that's related to the pandemic, such as the employment sector and industry sector. And just really, I guess, quick sort of understanding early arrears from the emergence from sort of accounts that were opened since those policy rules were introduced. So it's just close monitoring, and then with a view to try and perhaps relax those rules when there's a little bit more comfort that the bad debt hasn't gone beyond unmanageable levels.
So it's almost like in the short term, everyone sort of like tightened the cutoff scores, but I suppose then there'll be a gap that kind of builds up between people who are more aggressive in terms of trying to bring those customers on versus not, and will take more risk versus not. But it seems like there's probably a bit of a gap. I mean, that could be a potential market opportunity for some folks, or extra risk for those folks as well if they don't get it right. Absolutely, yeah. So still talking about acquisition. I mean, did most customers sort of drop off in terms of their acquisition, and then have you seen sort of changes in terms of as people got used to the crisis and sort of? I mean, it felt like at the start there was very much almost like a knee-jerk reaction saying let everything stops, which will then flow through to losses as well, interestingly as well. So everything kind of stopped, the new lending kind of stopped. Have you starting to see that coming back now? I mean, as people got more comfortable with it. I mean, has that been like a 6-month hiatus that is now restarted, or do you think we've got more to go?
Yeah, I think we've certainly seen in the mortgage market, there was that pause, I suppose, initial pause, or really a considerable reduction in new mortgage lending. But with the introduction of the government measures such as the stamp duty freeze, that it very quickly bounced back. In fact, I think mortgage lending has seen sort of record levels recently. But consumer lending, yes, has been different, and I think that's been probably a longer period where it will take a longer period for it to go back to normal levels, because yes, I guess consumers are less demand, perhaps some consumers want to sort of, with the economic uncertainty, are less inclined to buy that new car or those goods that they perhaps would have done. But then you've got the other consumers who are impacted by either redundancies or business failures, who will be seeking credit.
And so, what's your view on going forward in terms of delinquency volumes, I suppose, and certainly in terms of like redundancies? I mean, do you think we started to see those coming through, but it doesn't feel like we're at the peak of them? But I mean, when do you think that's going to happen? How much more do you think we have to go through from just looking forward into like next year?
So I think arrears haven't quite started to trickle through. They may have just gradually trickling through with the measures coming to an end in October. So we will start to see, I don't think the impact is seen quite yet, but it probably will be seen early next year. So there will be an inevitable rise in delinquencies, particularly within consumer finance. Of course, then that means collections teams will have to manage more arrears cases, and do that in the face of strategies not being optimal, given that data that's feeding those strategies isn't quite reflective of the situation.
And what kind of percentage increase in volumes do you think? I mean, if it's 30% of people on payment holidays are still on payment holidays, that would seem like that's a reasonable volume of folks who probably might be at risk. I mean, do you think how much of an increase, your gut senses, do you think we're going to see?
Well, I think the mortgage arrears will see inevitable increase, but probably quite modest compared to what we're going to see in consumer finance. Yeah, I think it's the ramifications from this will be felt for quite a while, and yeah, that will inevitably lead to quite a considerable rise in arrears, but perhaps not to the same extent that we saw back in sort of the global financial crisis in 2008-2009, because of government measures, and we know that there's been considerable number of redundancies and business failures, but it's clear that the governments are keen and enthusiastic to try and get people back on their feet. So obviously, yes, there will be people that are quite impacted for a while, but I think I'd expect to see arrears increase considerably, but not to the levels they were at in the last global financial crisis.
And so obviously we're on the back of vaccines being approved, and I mean that's been in the news recently. Even though it might take like 6-9 months to roll out to the general population, do you think society's fundamentally changed in terms of the way we interact? I mean, we're on video now, but customers' spending habits have had to change. We've all had to buy online. Maybe demand has gone down a little bit. We know what's important versus not. Do you think it's fundamentally changed, or do you think we're just gonna, as soon as we get back to normal, if we ever get back to normal, but if we get back to normal, do you think people are just going to go back to the way things were and we'll be flying and spending like it used to be, or do you think there's been a more fundamental shift that we have to adapt for?
Yes, I think there will be a shift. I mean, even as we all sit at home, a lot of us have been at home for 8-9 months now, and so obviously when we get back to normal, we'll all be itching to get back into offices, and of course then traveling and spending around those offices will return, but not to the same levels, I imagine, as before. So I think behaviors will change. We won't go back to where we were before, but perhaps there'll be about a halfway house between where we are now and where we were before.
And how are you finding working remotely with your team and across the team? I mean, has that been pretty seamless in terms of working well, or is it has it been no real impact, or are there the things you really kind of miss?
Yeah, we're all based from home anyway, so we're all quite well set up to work from home and work remotely, and we have various bits of technology that we used previously to ensure that we keep communicating. But of course, it's not ideal. We're human beings. We need to interact socially with other human beings, and we like to go and meet our clients and speak to them, and socially and from a business perspective. So that obviously that's not been possible, but we've found ways around it. But yeah, I think it's when we do begin to return to normal, I think we'll all welcome sort of seeing each other in offices and working back in that environment again. But of course, there has been that insight into from other individuals into the benefits of working from home, and how you can spend more time with the time you spent traveling to offices, you can spend with families or doing sort of active things.
I think a lot of people I've heard actually feel like it's probably been more productive to a certain extent. I mean, there's a lot of work being done. Now we don't have that travel time, I think, as well. And it's almost like, how do you balance that? Because obviously kind of miss the social piece. And you imagine, we're going to be, it's going to be great to see people again. I mean, and it's going to be the almost like the social side of it as much as anything. And it's that I kind of feel. So, but I mean, are you finding that people are being more productive, or it's more intense working from home than it was before? Or is it very much the same?
Yeah, I think that's I think people are probably finding it hard to work, especially when it is intense from home, because you don't get the escape that you normally have, the chance to leave it behind in an office, or so yes, it has been it's difficult, but I think there are the other benefits, and certainly I think in our line of work we do a lot of traveling around the country, and I think our clients are more willing to, I think they will be going forward more willing to conduct certain activities sort of virtually, which will be fantastic for us. But at the same time, I think we will insist on having those occasional moments where the points where we should meet up and see each other, because there's clear benefits from that. I think we're all a bit exhausted now from 9 months at home, and I think it's clear that interacting is key, is very important.
Well, it's good to try and just get out and have a bit of a break during the middle of the day, isn't it? Sometimes it can be sort of. I've been saying earlier, I've been in this room for what, 9 months. I mean, I do go to the kitchen and stuff like that, but pretty much we're all in the same room. We all know each other's offices as well, like this via video, and this sort of it's good to just get out a little bit. And I think I'm looking forward just to going out and meeting people for a coffee or a bit of a catch up and sort of talk about other things. And that's where you come up with new ideas to a certain way.
It is, yeah. I think there's certain aspects of innovation that perhaps have been stemmed by lockdown, and not being able to feed off each other's ideas and be inspired by others, maybe sometimes those conversations you have in the office that aren't intentional, but just what I've been up to, can spark off and ideas. If you find out what they've been doing with a particular project, there'd be similarities in what you're doing, and of course those things are more difficult when we're all stuck at home. And
So what's your outlook for 2021? I mean, what do you think the key things are that we've got to really think about next year, given, I suppose, what we know is on the horizon, but I suppose also preparing for what we don't know as well, and being flexible around that.
Yeah, certainly. I mean, I think this next year, so a lot of things that were planned to be delivered this year have been because of COVID, and so certainly the regulator have been provided dispensations for certain deadlines. So a lot of work will be going into those this year and next year to get those things finished off. But of course, the panic has been, the deadline extended. There's been less of a panic to get these things across the line. I think that other things for next year, so hot topics. So I guess open banking has been a hot topic for a while, and it's been quite slowly rolled out. But I imagine the rollout of open banking will begin to increase as people see the benefits of actually having access to this data, and perhaps individuals will become more comfortable with giving consent to provide this data. And that's probably the world that we're moving to, is consumers, individuals holding their data and giving consent to various third parties to utilize it. So that will probably start to increase, I imagine. I guess there's other things like climate change was quite topical prior to COVID, and banks have been asked to understand the risks in their book from climate change, and these are not just physical risks from things like floods on mortgage, on properties, but also transition risks from governments and incentives to move away from things like petrol and diesel cars, etc. So banks have been working on this for a couple of years now, but this will be ramping up as they start to get more sophisticated in how they forecast the losses from climate change. And then, of course, another thing really from a conduct perspective is vulnerability, and that's probably ties in quite nicely with COVID as well, and of course people who are impacted by this is there's this. I think we've seen initiatives before from the FCA around treating customers fairly. I think this is taking it that step forward and understanding which of your customers are vulnerable and ensuring the treatment of those customers is appropriate.
And on vulnerability, what's the role? What do you think there's a role for machine learning in doing that and identifying vulnerability? Have you seen a lot of that being done? And just in terms of, I suppose, because you can dial it up in terms of like making sure you're always over identifying it, but have you seen anything around that in terms of like using extra data to be able to identify whether people could be potentially vulnerable and flagging it, almost like pre-vulnerability?
Yeah, absolutely. Yeah, I think there's definitely a scope to use modeling techniques and machine learning. Of course, we'll do it better than traditional modeling techniques. I think also open banking data will help facilitate this, to understand an individual's sort of financial circumstances and get into their understand their income and spending, to flag these individuals, and of course then put them through a different channel and ensure that they're being treated appropriately.
Nevan, it's been great to chat with you. Really interesting to hear about some of your ideas and what's gonna change in the future and where we are now. I mean, it's just been a terrific amount of change, I think, over the last year, and you can see you've sort of been in the centre of that, certainly from a data analytics point of view. I think it sounds like we're going to have more next year, but there's lots of new things to think about. Hopefully, there'll be some interesting new opportunities for us as well to think about things differently with things like machine learning and stuff. So,
absolutely, yeah.
So I really appreciate the time. Thank you very much, and it's been great to chat to you.
Thanks, Chris.